Well, hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The core PCE has been going sideways for the last couple of months, and if you think the Fed is on a declining rate path, which we do, that's probably leaning toward the pause camp. We know the target is 2, and they're trying to get there gradually. This underscores the message that the Fed knows policy is restrictive, but they're not going to be in a hurry to cut rates unless they see, a more convincing decline in the core PCE. Looks like it's going sideways for now.
One of the key factors that they need to look at is this consumer spending, the fact that incomes are up by $4,000 as well per year. And so truly relying on that ability for our consumers to continue to carry our economy. It's what powered the GDP numbers this morning as well.
About 50% of our apparel is private label, meaning that we source that. And so we decide the country of origin where it's made. We've moved a lot of our goods to what we believe are going to be lower tariff countries. I am concerned, however, because there are certain goods that can only be made in countries like China. One of those categories that's relevant right now is Christmas ornaments and Christmas decor. Those lines are highly capital intensive and they're high cost to move.
We got 1 hour to go until the market close, and we're taking a look at the major averages right now, which are deteriorating as we get through this holiday shortened trading week. We're close tomorrow for Thanksgiving, of course, and then is a shortened trading day on Friday. Right now, the Dow pulling back from its record close yesterday, down by about 132 points, a little shy of 1/3 of 1%. The S&P down a little more than 1/3, 1%, and the Nasdaq is leading the declines here today, down 0.6 of 1%.
Yeah, and it is the day before Thanksgiving, so you would expect a more, a thin trading session, and that can exaggerate some moves here. We did get a rush of economic data today. That was front and center, Julie. Of course, all eyes were on PCE, the Fed's preferred inflation gauge, and that was interesting because core PCE came in line. Did climb, though, 2.8% from October last year. And so I think just kind of reinforcing that idea that maybe the road back to that 2% target could be bumpy, as our central bankers have been telling us.
Indeed, and sort of giving more ammunition to the idea that the Fed might not cut rates in December, rather. But all of that said, we see yields lower today. To be sure, thin trading session, as you pointed out, but still it's worth mentioning. Also worth mentioning the movement that we're seeing in semiconductors today, which is notable in that it is down pretty broadly across the board. NVIDIA down 1.7%, but Broadcom, TSM also down just to equal it here. And look at all of the declines that we're seeing. There's not necessarily a big catalyst, as you say. Thin trading day, it might just be people taking some profits in some of these names, but still interesting that we're seeing.
And also maybe just big moves, and speaking to what some strategists talk about here on our show, which is this broadening, this rotation into other names, right?
Yeah, could potentially be going on. Why don't we look at sectors real quick, too, to see if there is a kind of rotation. Tech, consumer discretionary down the most. Consumer discretionary has been a big winner as of late. And then we've got real estate and healthcare communication services to the upside.
All right, let's give us some more perspective on this. For more on the latest market moves and what's to come, let's bring in Tom Hainlin, U.S. Bank Wealth Management Senior Investment Strategist. Tom, it is great to see you. So, let's start, Tom, with that rush of economic data we got today, Tom. Just interested in your broad takeaways and what you think it means for the market.
Yeah. Hello, Josh. Julie, great to see you both again. We would characterize that inflation print as inconclusive. We heard your guest mention earlier, really sideways moving. If you kind of move it to 6-month average, you're at about 2.3%. If you smooth it on a 3-month average year over year, you've been stable at about 2.7. So a little higher than the Fed's target, but doesn't, we think, move the needle on what the Fed may or may not do at the December meeting. We think it does set up that December 6th labor market report where we'll get the November job print. It was really noisy for October that we got in early November because of hurricanes and because of the auto industry. I think it's really an important data point that we'll get after the Thanksgiving holiday to get some ideas on what the Fed may do in December.
Tom, I think it's interesting, too, that you've been sort of sifting through the earnings this season to try and figure out what some of the takeaways are. So looking at sort of your 3 takeaways here, or 3 things that you've gleaned from them, one of them is that big box retailers were mixed. So what does that tell you about the holidays?
Yeah, we think it adds a bit of uncertainty into holiday spending season. The data coming into the holidays was pretty constructive for consumer spending. Retail sales were pretty good. Wage growth has been good. Job gains have been pretty solid. But we did see some mixed results from some of the retailers here. We think it sets up some uncertainty. It perhaps is maybe more company specific. But we're going to need to see more data as we get now through the Thanksgiving holiday into the holiday spending season and perhaps get underneath that uncertainty. But net, we still think it's a good setup for the end of the year, both for the consumer and for businesses. We think wages, jobs, spending all still remain pretty resilient. We think it does set up for a good end of the year. But again, some of those results from the retailers were a little bit added uncertainty.
Tom, sticking with the retailers, certainly some of those names could be, in the bullseye of tariffs. Trump is coming back in the White House. He's talking tough. When you talk to clients, Tom, and they ask you what could tariffs mean for the economy, for the market, what are you telling them?
What we do is we look at what's kind of happening in the headlines, and we kind of caution people not to extrapolate too much into the future on what actually will happen. And so what we need to see is what the policy set looks like as we get into January, as we get into the new congressional session, as we get into the new presidency. So for us right now, it's really more of a broad-based approach. Don't read too far into individual headlines or proposals, because some of those may change as we get into the new year. They might be negotiating or bargaining positions. And our focus has been, look, this is a market no longer driven by those big cap tech names, as you've been discussing. You've got financials at all-time highs, industrials. This is a really broadening out market rally. We think it's investors would be well served to continue to participate in that, rather than try to kind of parse and identify what particular sectors or industries or companies may benefit or be hurt by proposed tariffs or trade actions.
Tom, what have we been hearing in companies' commentaries about what they expect next year, either about the policy backdrop or just more broadly, what kind of demand they're seeing right now?
Yeah, Julie, that was probably the most surprising thing we heard from third quarter earnings reports, is how reticent companies have been about giving forecasts for 2025. They've been pretty close to the vest in terms of what their outlooks. We think that had a lot to do with the uncertainty around not just the election results, but whether you'd have definitive results on election day or near election day. So we think we're going to get a lot more information in fourth quarter results that'll start coming out in mid-January. It causes a little bit more of a event headline kind of risk over the next 6 to 8 weeks here. But that was a surprise to us that companies were pretty hesitant to provide forward-looking guidance. We think we'll get a lot more of that in January when we start to get fourth quarter results.
Tom, Dell reported results and is getting just whacked today. That's one of those names that investors really bid up. They saw it as a smart way to play that AI theme. As we head into 2025, Tom, are you bullish still on that kind of mega AI theme and trade?
Yeah, there was weakness in kind of all the PC related names. You're not seeing that recovering demand for PCs from consumers, perhaps on the business side, those natural upgrades. But consumers had done that upgrade cycle during the COVID pandemic, and you're starting to see, and that we saw weakness both on the hardware manufacturers as well as some of the electronics retailers. But there are other ways to kind of play AI, as it were. You're seeing the utilities at all-time highs. That has been perceived as a defensive sector, but there's a lot of growth in utilities from data center demand and all the the energy that it needs and required for those AI, that AI universe. So we still see things like utilities as kind of a sneaky growth play for AI as well.
And what about in fixed income? I mean, that's been tricky lately, hasn't it? With the 10-year yields, sort of staying stubbornly high, but also seeing an uptick in volatility.
Yeah, we think the 10-year treasury is about fair value here, call it 4.2 to 4.4%. We think that's a reasonable price for 10 years based on growth and inflation expectations. So we think it's been important for investors to kind of look beyond treasuries for diversified income streams. And for us, we don't want to get too far in the details and the weeds on sectors, but places where you've got tremendous support, like for example, for homeowners and residential mortgage-backed securities, especially those that aren't guaranteed by the government. You've got home price appreciation, you've got home equity appreciation, and you've still got strong job gains and reasonably low inflation here. So we think there's good positive operating leverage in places within the bond market, like those residential mortgage-backed securities.
Tom, I'm just curious, final question. Do you see opportunity internationally, Tom, overseas, or would you rather stay U.S.-centric for now?
We think there's two different growth drivers there, and we kind of like them both. In the United States, you've got just that strong momentum in economic growth and corporate profits. You go into Europe and Japan and emerging markets, and what you have is just really low expectations. Valuations are starting the year of 2025, if we kind of hold here, at multi-year lows in terms of multiples of price to earnings. So we think there's relative upside if you just get any kind of good news. If you do get that stimulus out of China from the policy proposals that you've seen there, you could get a recovering demand for European consumer goods and Japanese capital goods. We think valuation is so low, it's an attractive place more from a recovery, where the United States, we're just kind of seeing this really strong economic and profit growth momentum.
Tom, thanks so much. Happy Thanksgiving.
And to you both, Julie, Josh, it's great to see you.
You too. Take care.
Thanks.
We're just getting started here on Market Domination. Coming up, how should investors be preparing for President-elect Trump's second term? We'll be joined by a panel of experts on the other side to discuss the effect of potential tariffs in particular. Plus, shares of HP lower today following its latest earnings report. Yahoo Finance executive editor Brian Stasi catches up with the company's CEO Enrique Loris at 3:30 to break down those results. Stick around. We've got much more Market Domination still to come. U.S. politics have, of course, been driving dramatic market moves, with the market expecting a pro-growth Trump administration. However, changes in the macro and market backdrop could mean a different situation unfolding for President-elect Trump's second term than in his first. Here to discuss, Dirk Willer, Citi head of a global macro strategy, along with Jens Nordvig, founder and CEO of Exante Data and Market Reader. Guys, thank you so much for being here. I want to talk about first the Trump economic team, which now seems to be pretty much set, with Kevin Hassett announced as head of the National Economic Council. We know, of course, Scott Bessent is going to be Treasury Secretary. Jens, I want to start with you because you put out a note this week where you talked a little bit about Scott Bessent. You know him personally, and you have for a long time. What does it tell you that Trump's picks for some of these economic positions have seemed to be more, for lack of a better word, conventional or safe, or whatever you want to call it, compared to perhaps some of his other cabinet picks?
Yeah, I think it's very important. So I've known Scott Bessent for a long time. He actually was my very first client when I launched Exante Data back in 2016. So we've had many discussions about the global economy over the years. And the reason why it's important is that we have an incredible amount of uncertainty about the policy outlook. What's going to happen to fiscal policy? What's going to happen to trade policy? And obviously, Scott Bessent is not going to be the president, but I think he's going to be an important voice within the administration. And I think he's going to work very, very hard to reduce tail risk for the economy and for markets. And you can see it already this week. As soon as we had the appointment, the bond market started to rally. Essentially, kind of the risk premium that had started to sneak into yields started to get priced out. So we got a very clear and quick indication from the market that this is something that people view as a stabilizing factor, and I strongly agree with that.
Dirk, I want to bring you into this in a minute, but Jens, first of all, follow to you. How exactly does he manage that tail risk? I mean, the purview of the Treasury Secretary, even though it's big, it's still limited. And as we know, in the past, there have been times when, in the first term, Trump sort of, outvoted, so to speak, some of his cabinet members. So how do you think he manages that tail risk?
Yeah, so I think if you look at it legally, okay, what's the specific role of the U.S. Treasury Secretary? It's one thing, right? But clearly, Trump is going to appoint people that he listens to. So you're going to have a dual role. You're going to have your formal role in the Treasury Department, right? And you're going to be an advisor to Trump. And I think you can already see it in some of Trump's rhetoric when he talks about the corporate tax rate. He said, we're going to try to lower the corporate tax rate. And then he says, we probably can't get it lower than 20%. That's a person talking that is aware of very, very challenging budget math, right? When Trump came in 2016, the budget deficit was around 3%, and he expanded it to 4.5% within 3 years before the COVID shock, right? This time around, the deficit is more than 6%, and expanding it further is going to be very hard for the market to handle. And I think the administration is aware of that, and I think Scott is going to push that view that there needs to be a degree of fiscal discipline in place here.
Dirk, I want to bring you in here as well, because I'm very curious about your thoughts, Dirk, on that same question. As you look and Trump rounds out, this economic team, Bessent, Lutnick, Kevin Hassett, longtime Trump advisor, well known in conservative economic circles. Dirk, what did you make of those picks, those nominees, and what they tell you?
Yeah, I agree that it's a great team. I mean, I know Kevin fairly well, and I must say great appointments across the board in the key economic positions, really. And you can see the market indeed priced out a lot of fiscal risk. We call it the Bessent unwind, if you like. So now, both rates, but also the slope of the curve and price and inflation at the back end of the curve is lower than where it was before the election. So that's clearly the market giving up on the view that there could be extremely expansionary fiscal policies in the short term that would cause havoc with the curve and with inflation expectations. I would also say, though, something that we call the Trump supremacy, in a sense that it's really, he listens to a lot of opinions, but in the end, he is the decision maker. He wants to be the decision maker. And so I would say even a strong economic team is not a guarantee yet that the policies will not be more expansionary than the market is hoping here. But certainly so far, the market is giving the team the benefit of the doubt.
Most definitely, Dirk. What do you think is the highest risk, Dirk, amongst the policies that are being floated, both the highest risk, but also one that is still somewhat realistic?
I mean, we wrote a lot about sequencing the Trump trades, what comes early and what is very likely and what comes later and maybe is less likely. And the things that will come early and are very likely are, of course, the tariffs. And we can debate whether it's broad tariffs or narrow tariffs. And I think Kevin, for example, of course, has been very good in the first round of tariffs, really targeting goods very specifically to avoid a major impact on inflation. And I'm sure they will do so again. And so if it's narrow tariffs, maybe the inflation impact will indeed be not that large. The risk is broad tariffs, because with broad tariffs, there's much less the corporate world can do to reroute trade and to keep inflation relatively low. So that is a key risk. Then the next set of issues that will come later is, of course, the fiscal debate. I think that will become meaningfully after the tariff debate. And then there have been, of course, a lot of promises to lower taxes on all sorts of constituencies. If they all come through the way they were promised, and if at the same time the commitments to cut spending would fall short, which is always a risk, then the type of fiscal policies the market is just pricing out would come back very quickly. So both are, I think, important risks, and it's too early to disregard them for sure.
Jens, I want to bring you back as well, get your take on the same issue of tariffs, because obviously, Jens, you saw it. I mean, Trump made headlines this week, new pledges on tariffs. Mexico, Canada, punching hard though, Jens, although you could argue, Trump probably thinks he also has leverage there. He has the upper hand when it comes to Mexico and Canada. But your thoughts, Jens?
Yeah, so I think there is a broad consensus that tariffs on China serves many different purposes and should be used strategically. And I think Scott Bessent is a supporter of that. When you come and look at tariffs much more broadly, it is a much more controversial matter. And I think a lot of people, Scott Bessent included, would view a tariff threat against Mexico and Canada much more as a negotiating tool, right? Where the goal is to essentially get the border closed, make sure that the flow of people gets reduced. And that's the goal, as opposed to the tariffs themselves, right? So I think the risk is that those negotiations fail and you kind of get broader tariffs by accident. So that's what we have to worry about. But what we can say with high conviction is that there will be much higher tariffs on China, and that is actually the goal. And that's for military reasons, it's for political reasons, and for economic reasons. And there's broad consensus, not just in administration, but also in Congress, to go in that direction. And that's why that is so much higher probability than a broad-based tariff.
So Jens, in China, let's say I asked you for your forecast, your estimate there. You think tariffs get ratcheted up to what, Jens? And you think Xi Jinping responds how?
So we have, at the moment, a number of goods, right, that have 20 to 25% tariffs. And then Trump obviously announced that we're going to have an additional 10% tariff on everything, right? So in round terms, say we're around 30%. There's been talk about taking tariffs all the way to 60%. And I think over time, they will test, okay, what supply chains can take it and so forth. But I don't think getting from 20 to 30 is the end destination here. I think it's highly likely that we get at least to 40, perhaps early on in the administration even. And then they will figure out which goods are going to be affected and so forth. But substantially higher is something I think we can say with high conviction even.
And Dirk, there's been a lot of talk and a lot of analysis about the perhaps more creative ways that China may come back with retaliation, not directly with tariffs, but supply chain restrictions, et cetera. From an investment perspective, does it make any sense to look at China right now, both given the domestic dynamics there and given that there is this potential trade war brewing?
Yeah, it's a good question. I think you can maybe justify a trade at certain times. It's very hard to justify an investment because you, of course, have this continuous risk that sort of disastrous outcome. Even if it's a tail risk, it is, of course, there. And investors learned the lesson from the Russia episode that has to be taken into account. But trades will, of course, happen. I would say a lot depends on the sequencing. And right now, the most likely sequencing is that first there will be a fair amount of Trump policies targeted at China, and that may again be a negative force for Chinese equities and Chinese assets. But then, in response to that, there could be, a large fiscal stimulus the market has been hoping for. One is that is more targeted to consumption, that is larger than what we've seen so far. And when that is coming, especially when it comes at a time when equities in China are even more beaten up because of U.S. policies, then that could be a good entry point, for example. So I don't think it became a sort of a country that you just should never be involved in, but it will be tactical rather than long-term, and right now is probably not the time yet.
And Jens, when you look around the world at different assets, whether you're talking about currencies or equities in various markets, as a direct result of this incoming administration, is there something that you think is so risky that and is going to have so much volatility that investors should just not be looking? And conversely, is there something that's just a screaming buy right now?
Well, I think when you think about international exposure, including international equity exposure, it's all very closely linked to what the dollar is doing, right? So we have a situation where we've had pretty dramatic ups and downs in the dollar since September. We were weakening dramatically into the Fed rate cut in September, right? And now we've had a strengthening period maybe up until today. So what's happening with the US yield curve, what's happening with the dollar really sets the tone for international risk assets. And I think if we get to a point where we're comfortable that the Fed is on an easing path again, and they can go substantially low on rates. If we get to there, the dollar's going to weaken as well, and it's going to be a major, major support for international equities that we just talked about are very cheap on a number of valuation metrics. So I think that's the dynamic to watch right there.
Guys, thank you so much, and have a great holiday. Jens and Dirk, appreciate your time.
Thank you.
Well, President-elect Donald Trump has picked yet another controversial name in healthcare, in contrast with what we were just talking about for his economic policy team. Joining us now with more, Yahoo Finance's Anjali Khemlani. And really, there is a very sharp contrast with what we were just talking about with Trump's economic team when it comes to the suite of healthcare folks he has named.
Right, that's right. A new pick named just yesterday, Dr. Jay Bhattacharya, who is going to be the pick for National Institutes of Health. If you remember, that's the agency that the U.S. has that's funding all sorts of research into diseases, into vaccines. And so if you see the slate of characters up on your screen right now, between the picks of RFK Jr., Marty McCarry, and Dave Weldon, we have some individuals who have been very anti-vaccine, anti-abortion, as well as anti a bunch of other things, all on the same stage. And so while their views align, there are differences in how they are perceived in terms of levels of threat, especially to the global health community. So one of the things that I've been focusing on is we saw during the pandemic, the US FDA and CDC really get a lot of attention for the work that they've done, and countries would just sort of blindly follow suit with the trust that the US regulatory agencies have done the work to then make recommendations, to then approve vaccines. And that is what some individuals have told me is at threat. Now, the US enjoys this privilege as part of a group on the main stage, on the global stage. The World Health Organization has included the FDA, the CDC, among others like the European Medicines Agency, Canada's Health Agency, Australia, Japan. They make up what the World Health Organization relies on to approve all these policies and to then effort global public health strategies. That could be at threat right now. That could be threatened by these picks from the Trump administration. And then if you look at sort of the buckets where they could have impact, it's public health funding. We've already seen that Trump pulled out of the World Health Organization early on in the pandemic. There's also research funding, disease monitoring, knowledge sharing, and regulatory trust that I just talked about. One source told me, that's Angie Rasmussen, we've had her on before, you might remember from the pandemic days, telling me if the FDA is no longer a functional regulatory agency, if the CDC can't investigate disease outbreaks, and if NIH can't carry out or fund research, the US will be a cautionary tale for the world, and that is definitely unfavorable.
What interests me, Anj, about this, and I'm interested to get your thoughts about this, is when I look at some of these picks, and especially a guy like Kennedy, who is popular, right? And millions of Americans look to him. He has an enormous megaphone. I just wonder how much of these nominees, it's about a bigger theme of how many of Americans are just disappointed and frustrated and angry at the kind of just public health leadership, public health apparatus about COVID. There's anger about that.
There is.
And whether Kennedy is ultimately confirmed or not, and we have analysts on the show say this guy's going to have a tough fight, whether he's almost confirmed or not, that seems to me to be a powerful theme that's being reflected in these picks that is going to keep playing out in different forms.
Yeah, I agree with that. I think all of these picks had some form they were popular during the pandemic for getting that sort of going against the grain, right? There are themes of anti-vaccine, of the science is not there, because in the middle of a pandemic, the CDC and the FDA are doing what they can with the limited amount of information in real time, making decisions, and then you've got folks questioning whether or not any mistakes were made in that process, whether or not boosters were in fact necessary. All of those are questions. I think RFK's popularity also has been stemming from the food conversations. There's some areas where families can get behind. There is a growing awareness of those kinds of things. And so that is why there's a popular movement behind them and to support them, to ask the questions from an agency and from a government body that seems to have been keeping information away or not been able to correctly communicate what the facts are. And we've seen how dangerous those impacts have been of their platforms. It's not that this is just fear-mongering. There is the measles outbreak in Samoa that is directly linked to a combination of mismanagement by the government agencies and RFK being there and spreading anti-vaccine efforts. There's also a recent news article citing Montreal removing fluoride in the drinking water as a direct result of RFK's platform. So we're seeing these real-world impacts, and it's just one of those things where the established scientific communities are saying that this is dangerous. We have been moving away from this and trying to push in a different direction for so long, and now all of these efforts are taking everyone steps backwards and years backwards from the scientific progress that has been made.
Big topic. Anj, thanks so much for breaking it down. Appreciate it. Stick around, much more market domination still to come.
We're tracking shares of HP following the company's latest earnings report. Let's bring in Enrique Lores, CEO of HP. Enrique, always nice to get some time with you. Talk to us a little bit about, normally I always start on the PC business with you, but I want to start on the printing business because it looks like sales rebounded a bit quarter over quarter. What did you see there in the quarter?
So let me start by saying that we had a strong quarter overall, but actually also strongly in print. What we have seen is that the market grew in both home and office hardware, and within that growth we were able to grow our market share, and this drove the results that we saw. Also, the supplies business performed well, we executed well, we continue to grow share in supplies, so the combination of growing share in hardware and growing share in supplies drove the results that you saw.
Enrique, I know you're not going to say this, but I guess I can say it. I mean, one of your competitors in the market, Xerox, is falling apart. I mean, they're really going through a lot of restructuring. Are you gaining market share from them in the printing business?
We are growing share in the printing business, and we stay very focused in executing our strategy. We see opportunities to continue to grow share, to expand, especially in the office side, into the segment that we call contractual. It is performing better than the more transactional space, and this is where we see opportunities for us to continue to grow next year.
The results from this quarter in print, are they sustainable as more companies bring workers back to the office?
Well, we think that the overall print market in 2025 will slightly decline. The decline will be less than what we saw this year, but our goal continues to be to perform better than the market, to grow share in profitable categories, and to continue to drive the transformation to subscription and service models that we have been doing over 2, 3, or 4 years now.
We were also watching Best Buy. Of course, you go into Best Buy, you can buy an HP computer there. They struck a cautious tone on their electronics business. What are you seeing in terms of electronics demand on the part of consumers as we lead into the holiday season?
Well, they were talking about electronics as soft, but they highlighted laptops as a category that was doing well. From our perspective, the PC market grew, our PC business grew in Q4, especially in revenue. The growth in our side was mostly driven by the commercial categories, but we saw growth in the premium categories, which is where Best Buy is more focused.
Are consumers just waiting for some of these AI PCs to hit the market?
No, we're not seeing consumers waiting. We have seen growth penetration and good growth of the AI PC category. In Q4, they represent about slightly more than 15% of our total PC shipments, and I would say the expansion and the growth of AI PCs is going as per plan. We also started to launch and to introduce some of the new next generation AI PCs, those that have the higher performing NPUs, and we are really pleased with, as we see new software developing companies taking advantage of the new capabilities and delivering great new experiences for our customers that confirm the opportunity that AI PCs have in the future.
How many AI PCs will you have in the market over the next 12 months? And as you look out towards the back half of your new fiscal year, what are some of the AI PCs? What are the specs on them? What do they look like?
Well, we will have AI PCs in most of the medium range and high-end categories, so which is really where we see the opportunity for them is going to be available, and we will have them in multiple form factors, from traditional notebooks to all-in-one, so really a strong push to diversify and to expand the AI business. What these PCs include is the ability to run small language models locally, which means customers can do inferencing at the edge, which means they can do it at lower cost than doing it in the cloud. It will be more secure, and it will also be faster. These are the key 3 attributes that the AI PC is going to be having, and we are starting to see very cool applications from real-time translation, real-time feedback, local processing of large documents, things that today you can only do in the cloud, but you will be able to do it locally much faster, much better, and secure.
I think the laptop that I have, Enrique, would be totally fried if I ran one of these large language models on it. I mean, how big? I mean, I think this says a lot. Maybe I should go out and get a new PC, but how how large of an opportunity is the AI PC market as you look out over the next 24 months?
When we look at the next 3 years, we think that about 50% of all PCs will be AI PCs, so which means it's a significant, very significant portion of the total PC business, and they will drive for the category a price increase between 5 and 10%. So it's significant in terms of size and also significant in terms of the impact they will have from a pricing perspective.
How disruptive would potential tariffs be to this AI PC rollout?
I think we have been working for a long time now to make our supply chain footprint more resilient. It's something we had talked before. We have been building factories in many different parts of the world, and this puts us in a much stronger position now than we were a few years ago, and we think in a strong position compared to other companies in our industry. And our goal is to work very closely with the new administration to make sure that we build and we define the best policies for our consumers and for our shareholders, and this is what we will be doing in the coming months.
You know, based on the research your teams have done, what components of a computer and a printer are most impacted by a tariff?
More than the components themselves, is going to be what are the products being built based on the current information, and this is why where factories will be located is going to be so important. But as I said, the information we have is still fairly fluid. There are different announcements happening in different points of time, so we need to wait and see what are the final policies going to be. But we have a very experienced team that has been driving this change for some time, and that will define the best answer for the company as we know what the final policies will be.
You've taken out a lot of cost over the past 2 years from HP. Are you inclined to eat the margin impact from tariffs, or you're going to have to pass on some of that stuff to consumers?
Some of that will have to go to consumers, given what is the overall margin that we have in the categories. But again, we need to wait and see what the final tariffs are for us to define what the exact plan is going to be.
Enrique, you're a true global CEO. Your operations are all over the world. I mean, you're always on the road. How important is it that the U.S. has good trade relations, not only with China, Europe, Canada? How important is that to your business, if not corporate America at large?
I mean, we, as you said, we are a global company that do business in many parts of the globe, that does development in many parts of the globe, and that has manufacturing in many parts of the globe. So for us, an easy way of trading across countries is the preferred option. But as I said, we will work with the new administration in a collaborative way to define the best model for the companies and also for the country.
All right, we'll leave it there. HP CEO Enrique Lores, always good to see you. Happy holidays to you and yours. We'll talk to you soon.
We just heard there from HP Inc. CEO Enrique Lores. We're seeing a big sell-off from PC makers after Dell and HP missed quarterly estimates. For more, we're now bringing in Bob O'Donnell, President and Chief Analyst at Technalysis Research. Bob, it is great to see you as always. Let's talk more about Dell and HP, Bob. A common theme there being the PC. Revenue in Dell's PC business drops 1%. That missed. Sales in HP's PC unit, Bob, rose 2%, but that missed as well. When is the great PC refresh cycle, Bob, going to come? And when you look out, is that 2025? Is it 2026? And what's going to drive that, in your opinion?
Thanks, Josh. First of all, great to be here again, as always. And yeah, look, the PC market's in a very, very interesting time. And to specifically answer your question, I think 25 is the year where we see a lot of this happen. When we think about it on the commercial side, you've got several different factors going on. Number one, we are 4+ years past the pandemic, and a lot of PCs were bought at the beginning of the pandemic, and that 4+ year time frame is when there's typically a refresh anyway. So that's number one factor. Number two, we have the transition to Windows 11 being driven by the end of support for Windows 10, and that's happening again in 2025. And then last but not least, certainly, is the move to the AI PC. So a lot of corporations are saying, all right, look, I've got all three of these factors going on. All of this makes sense to help me drive a large purchase, a large refresh. And I think that's why we've seen, in general, these stocks have done very well for the first part of this year. They're hitting some realities, which I'll get into in a second. But I think, moving forward, those fundamental factors have not gone away. They have not changed. Yes, tariffs can have an influence here as well. But still, you've got a lot of businesses are going to have to refresh their PCs in 25, and that's going to help both Dell and HP.
Hey, Bob, it's Julie. Can you help me understand something about PC refresh cycles? You've been talking a lot about the corporate demand, right? And, the Windows driving that. Does the corporate refresh cycle happen at the same time as the consumer? Does one yield lead the other? Or are they sort of independent of each other?
They're really independent of each other, Julie, and especially because, during the pandemic drove an unusual corporate refresh. If you'll recall, back in 2020, there was a huge burst in PC sales, most of which was driven by corporate, because all of a sudden people had to work remotely and people didn't even have cameras in their notebooks. I mean, that's how old some of these things were. So there was a huge refresh then. Consumer has been always a cyclical type of thing where you've gotten a certain number of people every year that refresh. The excitement that people are interested in is AI PCs, but in truth, for consumers, it's a tougher story. It's not as clear what some of the benefits that consumers are going to get for it. Yeah, it's a better experience, and if you do high-end video editing or music creation, there's a number of pretty cool apps that are out there. If you're a traditional mainstream PC user, the AI stuff is still being worked on. On the corporate side, on the other hand, things like text summarization and collaboration tools and the ability to, improve the quality of your image when you're doing a video call, all of those things have absolute day one, first day you use it, benefits. And that's why it's easier. You have to, however, consider one other factor, and that is this huge semiconductor transition we're seeing in the PC market. And so this is, I think, going to be a factor that we're going to see play out in 25. Obviously, we had Qualcomm with the initial Snapdragon stuff for the Copilot Plus PCs with Microsoft. Then Intel just came out, and AMD came out with their chips that are Copilot Plus. And there's a lot of rumblings that at CES, NVIDIA is going to enter the fray as well. So there's a lot of things going on out there right now. People are trying to figure it out. I think that's a little bit of why we're seeing some of the pause on the consumer side. There's a little bit of confusion out there with regards to that. And on the commercial side, some of those same factors, but for slightly different reasons.
I want to switch gears a bit, Bob, talk a little bit about Dell's AI servers, because what they said here, record AI server orders demand, 3.6 billion. I'm just curious about, what do you see ahead for that business? I mean, does AI provide as much of a big opportunity for Dell as the company thinks it does?
I think it does, Josh, and let me tell you why. And I just did some research on this to help that confirms my thinking here. So I did a study of 1,000 U.S. businesses asking about their interest in running AI models on-premise, that is, in their own data centers. And of course, to do that, they need servers equipped with NVIDIA GPUs. And that's exactly what I think we're going to start to see play out in 26. And we'll see that for for HPE, for Dell, for Lenovo, and even Cisco is getting back into doing some servers for that market. And the reason why that's happening is most corporations still have a large percentage of their most precious, important data behind the firewall. Not all of it's on the cloud. And to use these foundation models for AI applications, you need to train it with your own data. So if that data lives within your data center, it makes sense to run some of those models within your data center. Now, to be clear, that's not going to be everybody, but it's enough of a movement that I think it gives some growth opportunities for these companies that frankly have had a hard time in the enterprise market because everybody's moving a lot of their other workloads to the cloud. All of a sudden, those become an interesting opportunity. And I think we will see that in 25. And I think Dell is well positioned. And, what Jeff Clark talked about on the call in terms of, it's all about Blackwell and they can't get as many Blackwells as they'd like. Hey, that's a reality that everybody is facing.
Bob, always great to see you and to have you on the show. Happy Thanksgiving, my friend.
Thanks, guys. Happy Thanksgiving to you two guys, too.
All right, time now for some calls of the day. Piper Sandler downgrading Workday from overweight to neutral. So Workday under some pressure, down almost 6%. Leading cloud platform, of course, for HR and financials. Now in the red today, in the red this year. This was, we should know, I mean, most on the street still bullish on Workday, but Piper's Brent Bracelin, and we know Brent well, smart guy, longtime analyst. He does downgrade to neutral. Talked about waning growth prospects, Julie. Doesn't have as much confidence, he says, that growth levers can in fact still fuel a recovery next year.
Yeah, and we should mention also that his call comes after the company's just reported its numbers, right?
Yep.
And that the forecast was disappointing vis-a-vis what some analysts were looking for. Subscription revenue forecast a little bit shy, really in line with estimates. It sounds like Brent is tired of being a bull on this name. He says he basically is tired of being disappointed that their growth is not re-accelerating
Sounds
here.
like you're describing a bad relationship.
Yeah, it kind of felt like that. He said subscription revenue growth declining for the 10th consecutive quarter. And he basically says, you know, there's been the continued erosion of growth and limited visibility into the timing of a recovery hinders our outlook on the name. He got tired for waiting for things to get better.
Takes his target down to 270.
Yeah. All right, we're also checking in on Bitcoin here. It's back up again. It's now over 96,000 as investors remain hopeful that the token will surpass that $100,000 mark. There is nothing, to be clear, there's nothing different today than there was yesterday or the day before that, as far as we know. There has been that general bullishness linked to the election of President Trump, or President-elect Trump, that his administration will be friendlier to the crypto industry, and that regulatorily they will remove some of the friction that had been in the system involved with banks being custodians, I should say, of crypto assets, among other things. A more crypto-friendly head of the SEC is expected. But none of that has happened yet.
Yeah, I mean,
right? So you know, it's a volatile asset. So why was it down? Why is it up?
Yeah.
I don't know.
Big, powerful move, I mean, since Election Day,
Yes,
which we've talked about with a lot of smart folks. You know, crypto now has a lot of powerful friends in high places.
Yes.
You know, it's Trump, we talk about Lutnick, RFK Jr.,
Yes.
should they get confirmed by the Senate? And to your point now, you're kind of, what really will their priorities be? Will it be regulatory scrutiny? The strategic reserve you mentioned, maybe we don't just hold, we buy.
Right.
As Senator Loomis talks about, we wait and see.
Yeah, and underpinning all of this is the fact that the long-awaited institutional adoption that those in the industry have talked about, it's starting to really happen in a more decided fashion, especially with the ETFs coming to the market this year.
Yep, good point. All right, coming up, we are checking in on some of today's top trending tickers as we count down to the closing bell on Wall Street. Stick around, much more market domination still to come.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst and most watched stocks of the session on Yahoo Finance's trending tickers page. First up, a look at CrowdStrike. That stock sliding as the company posts a weaker than expected earnings forecast. The share is down about 5% here. We talked about this one a little bit yesterday. The company, this is only the second report that they've made since their big outage on July 19th, and they did emphasize that some customers are sticking with them, but a lot of analysts are talking about the subscription revenue here as being, I don't know, it seems like the opinions are pretty divergent on whether it was okay or not, but it seems like it did fall a little bit short of at least some analyst estimates.
So what do bulls say on a day like this? Piper's Rob Owens, longtime analyst in this space, smart guy. You know, Julie, I always pay attention when Rob writes. Rob in his after-action report says, telling his clients, yes, visibility somewhat hazy into Q4, but bottom line, here's what he said. We think this quarter was a step in the right direction for the company, he says, as it continues to execute on the longer-term consolidation opportunity in security. Rob remains overweight. Target goes to 375.
Interesting.
So one man's opinion there.
Yeah.
Turning to Symbotic, those shares plunging after delaying its 10K report to the Securities and Exchange Commission, as well as lowering its outlook. So this was interesting. I guess a couple different headlines. Warehouse automation company, big customers, by the way. I mean, Walmart, Target, does cut its Q1 revenue. Julie said it was unable to file its annual filing due to what it said were, I guess, accounting errors is what we're talking about.
Yes, accounting errors is what we're talking about. The company just reported its earnings report back on November 19th. That's when we got this first quarter forecast. So the cut to this forecast and the announcement that they're delaying this filing coming just not even 2 weeks after their report. So this is really obviously proving alarming to some investors, and we see that big sell-off in the shares.
The company has been targeted by short reports we've talked about on the show. I did see some analysts downgrade the name, I guess thinking, listen, they'll move to the sidelines until some of this gets worked through.
Uncertainty is hanging over it. Yes, exactly.
All right, while we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages here. A loss of momentum in today's session after the record close we saw yesterday for the Dow and for the S&P 500. The Dow today down about 138, about a third of 1%. We did get economic data this morning, broadly in line with estimates, though, so it seems like this might have more to do with us going into the holiday, a little bit of a lighter trading session. The S&P 500 down about 0.4%, and the Nasdaq off about 0.6%. We definitely saw some large cap tech, including in particular the semiconductors, selling off and dragging down the Nasdaq today. Jared, what else you got? What happened today?
Yeah, I was looking at those weak semiconductors really flagging recently, but let's go back to the Wi-Fi Interactive. Kind of a ho-hum, a little bit of a negative tilt to the end. I was almost about to call this the end of the week. We got Friday, so don't count out the week just yet. I do want to check in on the bond market because we saw a downdraft in yields today and also the U.S. dollar. You can see down 6 basis points. That was after a pretty big rally earlier in the week, so that's a bit of a relief for the market. Similar story with the U.S. dollar index. Here's a 4-day look, and you can see that drop really occurring today. And then in sector land, we are going to see, here we go, real estate is the #1 sector, followed by healthcare. Then we also have financial staples, communication services in the green today. Tech was the biggest loser, down 1.33%. And let's get a look at that inside the Nasdaq 100. Pretty red board there. Alphabet barely positive and some other bright spots. But let's take a look at those semiconductors. A lot of red and a little bit of dark red. Broadcom down over 3%, so is Micron, so is Marvell. And we can take a look at a similar story in software where we have Salesforce down 3.8%, Oracle down over 4%, CrowdStrike just a little bit more, Autodesk down 8.5%. And then it's interesting to look at what's happening in unprofitable tech. Now you get rid of, you scale down Tesla and it's kind of a different story here. So some of the weaker companies have actually been doing better today. You see that in Coinbase. That's up 6%. That's kind of a Bitcoin story, but also Beam, DNA, Hood, etc. And if we take a look at meme stocks, this is my final board here, you can see some more love. So it has really been about some of the smaller names finally finding some relief in this market here.
All right, thank you, Jared. For more on today's action, let's welcome in now George Young, Villery & Company portfolio manager. George, it is good to see you. So as you point out, George, listen, you really focus on those small caps, those pint-sized companies, the Russell 2000, which, as you know, it's been flat over the past 3 years. What do you see ahead, George, though?
Well, call me an internal optimist, but I tend to think that there's a regression to the mean. Whatever's done well in the past won't necessarily do well in the future. So I'll pick on the Magnificent Seven. I mean, right now, out of the S&P 500, those 7 stocks represent about 35% of the index. So if you own those stocks, great, more power to you. You've done well for the recent year or two. But moving forward, we always have to look ahead, and there's a great saying, stocks are seldom cheap and popular at the same time. These are popular stocks. It's not going to last forever. It depends on PE ratios. By the same token, the PE ratio of the S&P 500 is about 25 times. If you look at those 7 stocks, it's 35 times. So they're very expensive stocks. If you want, I think it's better to look at ratios, things you can hang your hat on, objective measurements like PE ratios, as I said, asset values. Other companies offer a much better bargain. So that's what you should be buying.
And yet, George, we've heard from a lot of folks who are very optimistic on the small caps and have been for a while, and they have been waiting. Lately, we've seen that uptick, but it has definitely not been a straight line. We've seen a decent amount of volatility there. How do you know when that outperformance is going to take off? What are some of the signs and catalysts you're looking for?
Well, you're looking for a number of things. One that's important is to see the rise in interest rates. So using the 10-year government, you just showed a little while ago, it's 4.24%. The last 2 months, that's moved up from 3.6%. So we're in a slightly different interest rate environment. What that means is going to be a little bit more difficult for companies to borrow. By the same token, with Trump coming in, that means there's probably more chance for mergers and acquisitions. And if you focus on that for just a minute, that means that the smaller companies have more of a chance of being bought out by the larger companies. And again, somebody like Warren Buffett is constrained to buy the large cap stocks for the most part. Somebody like Villery & Company, wants to focus on small mid-cap stocks, and there's value there. So there's a reason we do that. Doesn't take as much capital to buy out a smaller cap stock, obviously.
George, more broadly, you point out the market list and focused on three big things: election impact, inflation, and of course the economy. George, we did get a wave of economic data today. I'm just curious what you made of that data, George. Did you hear anything or see anything that impacted your views of this market and how you want to be positioned?
Not necessarily. We tend to be long-term holders, meaning our turnover is something like 20% per year. So we want long-term. We want the advantage of long-term capital gains rates. We want the advantage of whatever stock we might be buying to understand what its thesis is and to have that play out in the marketplace. So we're not really focused on short-term trends. We're also focused domestically. So from a standpoint of trade wars, that doesn't bother us too much. We're looking at domestically, what can we do? What can our clients do? Where are the profits available?
So at least on the domestic front, one of your picks doesn't necessarily fit the bill. I'm talking about Freeport-McMoRan, big copper and gold producer, but doesn't mostly operate in the U.S., right? So why is that sort of a little bit of an exception to your rule?
It's an exception because the demand for copper is pretty permanent. The lives of the mines are 90 plus years. You compare that to an oil rig. We're in Louisiana. Any kind of oil production, that's got a life of maybe 10, 15, 20 years. 90 years is what copper offers. And the interesting thing is with copper, they're in very desperate places. It's hard to get to. You need to have very good relationships with the politicians. We're talking about Indonesia. We're talking about Chile. We're talking about very difficult places. And there's no substitute for copper. Arguably, if you're talking about energy, then you've got solar, you've got wind, you've got all sorts of alternative energy. Nothing else can replicate copper. And when you're looking at an electric vehicle, for instance, it takes something like 15 times as much copper. When you look at rebuilding utilities, as we've got to do in North Carolina, Hawaii, a number of places, again, no substitute for copper. You must have copper.
And George, the stock, though, I'm just looking, year to date, it hasn't done a whole lot, George. We're up about 2-3%. What are the catalysts that get this one moving higher?
Well, I'll give you the good news and the bad news about that. So China is one of the big users of copper. Chinese economy has been off, and there's questions about what's going to happen with our relationship, the U.S. relationship with China. But again, long-term demand, there's more and more copper, as I said, utilities, electricity, anything having to do with moving current needs to have copper. So no substitute around at all. So in due course, I think supply-demand will rebalance. Freeport in particular is one of the largest around. They're going to be able to name their prices in due course.
And then also, finally, another pick that you like is called Lineage. This company actually went public not that long ago. It's a cold storage company. The stock's trading below its IPO price, if I'm not mistaken. So I guess this fits into your value criteria too, George. Why do you guys like this one?
Well, a couple of reasons. One is they're the largest around. You're correct. They just went public in July. The founders are still heavily involved and will be for a long time. They own 70% of the company. They put their money where their mouth is. It's got about a 2% yield. It's structured as a REIT. So it's going to offer the income, but it's also going to offer growth in due course. We toured one of their facilities recently, and it's amazing how sophisticated they are. They've got over 90 different patents. They've got over 400 warehouses around the world. They are the largest in the world. They don't have too much debt. So think about chicken moving out of the United States, going to name your country, Congo, Uzbekistan. All the regulations trying to get them out of the United States into those companies are very sophisticated. They've got an FDA inspector there on site to be able to monitor everything. Fantastic company. Chicken, whatever's got to move, has to be frozen, has to be kept cold, cold, cold.
And there's a lot of stuff that does. George, thanks a lot. Good to see you.
Sure, you will. Thank you.
Take care. Wall Street is growing more bullish on the airline industry, sending airline stocks soaring in recent months. Here with the breakdown, Yahoo Finance's Ines Frey. Hi, Ines.
Hi, Julie. Yeah, especially the big main carriers that we talk about are United, Delta, and American Airlines. And this is a year-to-date chart of the travel sector. But you can tell United Airlines up 133%, recently hitting all-time highs. You're also looking at Delta Airlines year-to-date up 58%. And then even if you're talking about American Airlines, which has underperformed both of those two, American Airlines is up 6% year to date. But if you take a look since about early August, it's about 40%. So why are these big main carriers doing so well this year? Well, some analysts are saying that they may have turned a corner, so to speak, that we're finally starting to see a strong airline industry. And there's several drivers because of that. Part of that has to do with premium travel, the fact that these airlines are all offering premium travel, and demand for premium travel has really spiked, especially since the pandemic. Also, international corporate travel, that's strengthening as well. And then domestic capacity is in balance because you had a lot of domestic capacity earlier this year among the domestic carriers, and now it's a little bit more in balance. You've got the big main carriers that have also been expanding their domestic routes, and then you've also had the attempts to consolidate among the low-cost carriers. That also, I spoke to one analyst, is expected to be something beneficial for the main big carriers, because if you are traveling and you're going to get a ticket on a low-cost carrier and you're not sure if they're going to be around or what's going to be happening with that carrier, then you're probably going to want to pay a little bit more for these main carriers. There are still some headwinds for the industry. You've got, for example, a higher maintenance costs. You've got higher wages from those corporate, those pilot contracts that were signed last year. Also, even Boeing's delay on some deliveries. But nevertheless, despite these headwinds, I spoke to one analyst that said the fact that you've had these challenges and you still have these big main carriers that are doing so well, he said that speaks to the management of these companies, and that he's saying that we're finally seeing a strong airline industry in the U.S. and that they know it as well. So taking a look at where we're at for travel this holiday season, well, the TSA is saying that it's going to be record numbers for people traveling. Since yesterday all the way to December 2nd, they're expecting to be screening some 8.3 million people. That's a record for Thanksgiving, and that's 6% higher than the same period last year, guys.
All right, thank you. Appreciate it.
Thank you.
Well, coming up on the latest episode of our podcast, Opening Bid, Yahoo Finance Executive Editor Brian Sozzi dives into the nuances of the robotics industry and chats with Citi's Wenyan Fei and Rob Garlick about how the future of work will change because of humanoid robots. Here's a quick look at the conversation, and be sure to scan the QR code below for full episodes of Opening Bid, or check them out on your favorite podcast platform.
So we model 7 different use cases for humanoids based on the market that we think are going to be the biggest in the future. So we modeled home services like those robots doing the laundry, mowing the lawn, and we sized the industry market whereby the humanoid robots working in factories and warehouses. And we also do construction, parcel delivery, food and grocery delivery, supermarkets, hotels, like basically every big market that we included. And the number that we got to is 30 million in unit number by 2035 and 650 roughly by 2050 is the number that we got to in terms of units. And if you multiply by the pricing point that we are currently looking at is around 20 to 30K US dollars, and we are expecting it to gradually go down a little bit in the future. But I think by 2050, we are looking at a $7 trillion market for humanoid.
Rob, robots that can mow your lawn? What are we talking about here? A human-looking robot that is actually pushing a lawnmower? Like, how far away are we from that?
Well, look, the penetration of cleaning robots in the home in the US is already 20%. Okay, these like robots that go around and vacuum or mop your floor.
Oh, I love my Roomba. Big Roomba fan.
Yeah, there you go. And look, there are multiple different varieties of those. I mean, one video kind of samples 94 different versions of that. So it's not that you necessarily need a humanoid to try and change that, or a humanoid to substitute for your robot lawnmower that you might already have or not. So you've got to be careful around the fact that just because a humanoid can do something doesn't mean that they should do something. But there are plenty of things that we think that they can do that are going to be useful for you.
M&A announcements have shown signs of increasing in 2024, but our next guest says to expect moderate improvement of activity with upside opportunity going into next year. Here with a closer look at the road ahead for deal making and the sectors to watch, we have Ephraim Kaplan, Managing Director and Head of Services and Infrastructure at BGL. Ephraim, good to see you. This has been taken as sort of conventional wisdom at this point that the new administration and market conditions are sort of combining for what is going to be a better environment for deal making. But is that actually the case? What do you think?
Josh and Julie, good to see you both. Again, thanks for having me, and
too.
happy early Thanksgiving. I'd say from an administration perspective, we're quite optimistic about the market. If you think there's three components to the administration that we're excited about that balance each other out. Number one is if you think from a positive point of view, you got to look at the regulatory environment. It's been pretty challenging over the past few years in terms of the types of deals and the mega deals that can get done. So we're excited about what can happen here with the new administration. Secondly, just from a rate perspective, not only is there a decreasing rate environment that's coming, but the tax policies that the administration is, at least the rhetoric around the tax policies, gives a bit of a boon to the market. What I will caution everybody, which could put a little bit of a damper on optimism for the M&A market, is the tariffs. Listen, even though the inflation dynamic is moderating, and the Fed has done a fantastic job in terms of improving the environment from not only a cost of capital, but also inflation. Listen, tariffs can have to some degree a negative effect and put pressure on pricing northward. So that can moderate activity a little bit, but overall, the administration, we're excited about the incoming administration and believe it's going to be positive for the market.
And Ephraim, next year, to the extent that we see a pickup in deal making, what sectors, what industries would you expect to see the activity?
Yeah, Josh, good question. I'd say, unlike the past few years where, call it a stock pickers market, call it sector specific, we're expecting a bit more of a broader based recovery. If you take a step back and just think about the market in general and how to call it calculate what's to come, 23 was, for lack of a better way to put it, challenging. 24, our pipelines were building. It was a pretty impressive and optimistic state in Q1 and Q2 of 2024. Challenge being the election itself put what we call an undue amount of uncertainty into deal making. We needed the election to sort of make its course and complete. And then secondly, from a Fed perspective, we expected a much more positive rate environment throughout the year. And that didn't really happen until, as we know, September, and then the most recent 25 basis point cut. So with all of that behind us, as you clearly stated in the beginning of our segment here, we have optimism to the market. It's going to be a moderate recovery, but with those dynamics now completing themselves, we're expecting a broad-based recovery. If, for example, and I'm anticipating your next question, if we're thinking about sectors to focus on, there's no doubt the past few years, as well as going into 25, services, especially in the private capital markets, in the lower middle market, are strong. Infrastructure is a very strong marketplace. It's clear that everybody has optimism around the energy marketplace. And then listen, we're standing behind tech. From the pipelines that we're seeing, from the pitch activity and the opportunities that we're seeing, it's pretty impressive to see what tech has to offer in 2025.
I want to pick up on a little bit of this because I know you focus on areas including the energy transition, but also environmental infrastructure. And so are you going to maybe get a little bit of good, a little bit of bad? There's been some enthusiasm about building out the grid, about natural gas infrastructure, but maybe less so for renewables, for example. What do you expect there?
Yeah, I think you took some of the words right out of my mouth. From a renewables point of view, I think there are some aspects of ET, or call it decarbonization, the ET marketplace is, I'd say, still figuring itself out. The movement towards a renewable, sustainable energy infrastructure, climate infrastructure. There's a lot of capital being sourced, being built. The GPs, from a private equity point of view, have grown around tenfold in terms of the number of GPs focused on impact investing and energy transition. But listen, you have to be careful about with the incoming administration from what they're doing from a tax credit point of view, as well as subsidies towards the renewable infrastructure. On the other hand, you've mentioned environmental infrastructure. Sustainability is a growing trend. Now that's more resource conservation rather than, it doesn't need any subsidies. So from an asset class point of view, environmental infrastructure, sustainability is much more an infrastructure asset class, which frankly is putting upward mobility and more, I'd say, higher quality view on that as an asset class, which is enhancing the valuations of those types of assets.
Finally, Ephraim, what about price? I mean, how do valuations, Ephraim, just generally look to you here?
Again, great question, Josh, but there's no broad answer, especially when we're thinking about value. Every asset, every company is unique in terms of its offering to the market. What I will say is, if you look at the leverage loan market and how competitive it's becoming right now, where spreads are going, which are decreasing, which again enhances competition on leverage loans, that's a really good indication of reduced cost of capital. How does that translate into valuation? Well, clearly bid-ask spreads are being reduced. And one of the a decent amount of rhetoric over the past few years has been big bid-ask spreads with buyers and sellers. I'd say that's less so on the A+ assets and more so on BC assets. So what this allows is, again, a broader base recovery with lower cost of capital, putting more assets into the market. It should enhance, again, the M&A, which is why we think there's upside momentum, or we're optimistic about upside from an M&A point of view, because debt cost of capital, overall desire to transact are being enhanced right now. So yes, bid-ask spreads are reducing, and we expect valuations they're not going to change much, Josh, but the lower debt costs are going to enhance more activity.
Ephraim, thanks a lot. Have a great holiday.
Yeah, good to see you both. Happy Thanksgiving.
Thanks.
Bye-bye.
That'll do it for today's Market Domination Overtime. Be sure to come back Friday at 12 p.m. Eastern. Markets are going to close early. Be sure to tune in for all of your coverage leading up to and after the close of the bell. I'll be here on Friday, but this guy won't.
I sure won't. But don't go anywhere. On the other side of the break, I will be here for now. It's asking for a trend. And I've got you covered for the next half hour with the latest and greatest market-moving stories, so you can get ahead of the themes affecting your wallet. Please stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here are some of the trends we're going to be diving into. Black Friday and the start of holiday shopping is right around the corner. We're going to tell you about some key retail trends this season and what sort of impact inflation could have on your gift giving. Then movie theaters have watched ticket sales dip for years due to the emergence of streaming, but we'll tell you why they might be thankful for streaming services this holiday weekend. We'll also tell you what record Moana 2 has already broken despite being released just today. Plus, we're going to break down why the Macy's Thanksgiving Day Parade is one of the most valuable properties in live television and why it could soon be on a network other than NBC. Well, stocks closing lower the day before Thanksgiving here. Investors digesting a slew of economic data, of course. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. One thing has been pretty consistent since the election. That is small cap outperformance. And here's where I get my first point. Small is greater than large. And we've seen this play out with the caps. That would be large cap versus small caps. And I'll show you how this has played out in not only the sectors, but some of our leaders here. This is since the election. So I think we got 16 trading days here, Josh. And these are the large caps. But what I want to show you are our leaders. And here is IWM, 7.5%. What I want to point out is most of the things that are to the left of it are actually bigger than it, or are, some of the smaller things in the market. So Bitcoin, crypto, that's kind of a fringe market, kind of small. ARC Innovation, that's unprofitable tech. Aside from Tesla, most of those are pretty small. KRE is regional banks, so those are small and mid caps. Bets, gambling, smaller stocks. IGV is an exception. You're going to see Microsoft in there. That's software. Here we have PSCE, small oil, then IWM, and then you get all the larger stuff. And I'd point out, MAGS, that's the MAG 7 ETF, that's only up 5.2%. So it has been the case that small caps have been outperformed.
So what you're saying is we're in a giant time machine, Jared, and it's back in 2016.
And this ironically, coincidentally leads me to my next point, which is Trump's ghost. And I got an interesting chart here. This is 2016 versus 2024. This is about the first 1 quarter or so, and we're measuring days on the x-axis here, and the S&P 500 return on the y. And you can see we got a really big lift early on in those days after the election this year. That was not the case in 2016. It was more of a steady rise. But nevertheless, you can see the trend still kind of stair-stepping higher potentially. And what you'd want to see is something like this. Hasn't happened yet. So I think there's going to be a lot that we play out here. But, if you're wondering about seasonality.
I sure am. Well, it's a Jared Blickery hit. We got to talk about seasonality. Anything there?
VIX seasonality. Haven't shown this one in a while. I just updated it. So the blue line is the average. That's what happens going all the way back to 1990 when we first have data for it. The white is what happened this year. And you can see what usually happens is that right about now we are trending. We have already started trending down, and now into December, it's kind of that final stretch leading into the Santa Claus rally. We'll have to see how it exactly plays out, but seasonality is working in risk's favor.
Bottom line, we're heading into Thanksgiving.
Yes.
What's the one thing I need on my radar?
Well,
I feel like it's Jared. I feel like I was going to go greenback.
Yeah, we got to be watching the dollar here because the dollar is actually working in favor of risk right now, but that hasn't been the case recently. We've been tracking and talking about the dollar's rise, and let me just get a chart here of the Dixie. This is the U.S. dollar index, and it's not perfect representation, but it's widely known, so that's what we use here. This is a 3-year chart, and what I want to show is this rise right here because this penetrated to the upside this resistance level that's held for several years. So that got a lot of people concerned about the dollar being a wrecking ball. We went into detail on that the other day about exactly why that is. But here's since the election, and you can see, well, now we've actually come off that little blip there. That's actually somewhat sizable. So that's moving in favor of risk assets.
Jared Blickery, happy Thanksgiving, buddy.
Thank you. You too.
As we approach the biggest shopping week of the year, we are looking at trends in retail. Black Friday, Cyber Monday, they're right around the corner now, but with inflation concerns and political uncertainty, what can we expect from not only consumers, but retailers themselves this holiday season? For more, we're bringing in Adam Davis, Managing Director of Retail Finance at Wells Fargo. Adam, it is great to see you. So it's here, Adam. It's Black Friday, it's Cyber Monday. What should we expect? How strong is it going to be this year versus, last year?
This is the Super Bowl for every retailer, as you could kind of think about it. So what we're seeing is the consumer continues to be under a lot of pressure. Conversely, the retailer is also facing a shorter selling season than they have over the last few years, given it's almost a week shorter between Thanksgiving and Christmas. And so they are pulling sales forward. We've seen how promotional they've been. This entire week's going to be extremely promotional as they try to capture as much of their share of wallet as possible. And the consumers are out there looking for bargains. They're being patient, and they're trying to stretch their dollars as far as they possibly can. And I think it's going to be a great season for consumers to, pick up bargains, potentially trade down, and really find as much value as they can this year.
When you say, very promotional, Adam, what do you think there? Should I be, am I looking at 20% off, 50% off? What do you think?
Yeah, I mean, so Black Friday, you're going to have those doorbuster deals. The retailers, the inventory position of the retailers is not where it was 2 years ago, where there was just this influx of inventory given the supply chain challenges. So this year, they've normalized inventory to really meet sales expectations. However, they're fighting over that share of wallet. So they're going to be promotional to try to transact with the consumer and get their share of wallet. But what they're seeing is some retailers will do kind of a doorbuster or kind of a 20% store-wide, 30% store-wide, but they're also being very methodical. So maybe the sales are on a collection of items just to get you in the door on the website, just to kind of start the transaction. And I think that's where it gets really kind of creative, where the consumer can really kind of price shop and kind of look at other kind of options and potentially trade down to something, maybe it's not a branded product.
Adam, one of the trends you're looking at, I know, loyalty programs, right? And earlier today we had on JCPenney CEO Mark Rosen. He was talking with us about what they're doing in that space. Take a listen here.
We're actually really encouraged as we're going into the Black Friday weekend. Since back to school, we've seen a real change in trajectory in consumer traffic and in the sales trend in our business. I think a lot of that started when we launched our rewards program in the spring, and we now are going into holiday with twice the number of customers having our Cash Pass rewards in their pocket that they can spend during holiday. So we feel really positive about that.
Adam, your thoughts, your reaction to those comments?
Yeah, look, it's great. I mean, when you think about loyalty programs, whether there's a point system or just early access, there's a lot of perks that kind of come with that. And so as you saw there is a kind of cash reward type system, but it's a great opportunity to either get stackable promotions such that, you have your doorbuster promotion, and then potentially if you're a loyalty member, maybe there's another promotion you can kind of add in addition to that. There is potentially free shipping, free returns, which is important, obviously, and then just getting early access to what's out there. So that's from the consumer side. The retailer side is great because you have a captivative audience that have signed up with you. And so you can kind of have that relationship with your consumer and kind of see how things work.
Final question. I mean, we did hear, of course, a rush of retailers report earnings results this week. Some of those retailers, I thought it was just interesting. They mentioned the election, Adam, as if that was a reason. They said some consumers put off buying. I was just wondering what you made of that. Do you buy that, Adam, or do you think, no, that's just an excuse for posting underwhelming results?
Yeah, I think what happened is you had retailers, a number of them had softer results. Some of them actually had some better results. I think the consumer is just very cautious right now, right? And so as they're thinking about what their finite budget is, It's how they're going to kind of stretch it out. And if they're kind of thinking about, let me just get to Thanksgiving and then I can kind of see what promotions are out there. I just have a feeling it was more just let's just kind of put it off and see how big the promotions are going to be as we get closer to the holiday season.
Adam, great to have you on the show today. Thank you so much for your time and insight. Appreciate it.
Thank you.
With Thanksgiving this week, it means the unofficial start to the holiday season and what is expected one of the busiest shopping years of all time. Yahoo Finance did catch up with some folks out on the streets of New York City as well as Los Angeles to see how they may be planning to spend for the holidays.
The holiday retail rush is officially on, with shoppers expected to shell out $980 billion this season.
Picked up a couple of extra shifts, hoping to set aside around $500 for gifts for families, friends.
I'm budgeting around $400 for this holiday season.
Probably about maybe $3 to $5 grand.
The National Retail Federation expects a 3.5% bump in spending online and in store. That growth would mark the slowest rate in 6 years, despite improved consumer sentiment tied to cooling inflation and lower interest rates.
Like everything's too expensive. Prices are crazy.
Definitely leaning more into the promotions. If it doesn't have a promotion, I'm really not interested.
With Black Friday falling later this year, retailers began slashing prices early, rolling out promotions in October to make up for a shorter holiday season. Adobe expects stores to discount up to 30% off listed prices.
I'm just trying to budget and save money. You know, hours are getting cut a little bit, so trying to save and budget. So I'm just trying to use my Afterpay. I'll just pay it weekly, I'll just pay it monthly.
Some of the steepest discounts are online, with mobile phone orders expected to account for more than half of all online buying. Electronics, apparel, and home goods among the top-selling categories. But retailers warn about potential downsides, with consumers still reeling from higher prices. Target forecasts flat sales during the holiday quarter, while Walmart warned about stretched pocketbooks despite raising its sales and profit outlooks.
We see that they're buying less general merchandise. As they're spending more on food, there's less money to go to some of those more discretionary type items.
I'm cautious about the future, but I think right now we're celebrating what we have now.
The idea seems counterintuitive, but the box office might be thankful for streaming this year. Yes, it's true that theaters have struggled to match their pre-pandemic numbers due to more people opting to watch movies at home. But this Thanksgiving, many Moana fans will flock to theaters after first discovering the animated film on their couch. Joining us now is Paul Derger-Abedian, Comscore Senior Media Analyst. Paul, it's good to see you. So let's talk about this theme, Paul, which is interesting. The idea that you would watch a movie on your couch, you're relaxing in your family room, and it turns out you enjoy it so much, Paul, you're excited about it so much, that when the sequel hits, you're actually willing to get off that couch and head to the theaters to watch it. How much of a real trend, a real theme is that, Paul?
That is a trend, Josh, and it's really interesting because a lot of people think of the movie theater and streaming as adversarial, but I think of them as additive and complementary, because if you're super excited about seeing the first Moana at home and you're all geared up for that, if the new one is hitting theaters right now, guess what? You're going to get off that couch and you're going to go out to the movie theater. And this is really actually nothing new. I remember the first Austin Powers movie, it did about 54 million total. And then the sequel, the second film, earned more in its opening weekend than the first one did in its entire run theatrically. And that's because, guess what? People discovered that movie at home on the small screen and then had to go out to the theater to see it on the big screen. So this is just a trend that I think we've seen going on for a long time. With streaming, it's come more into focus because streaming offers a lot of content right there on your couch, like you said. But to go out to the movie theaters, we saw over this past weekend with Glicked, so to speak, Wicked and Gladiator 2, earning a combined $167.5 million domestically over the weekend. Now Moana 2 is already on track to have perhaps the biggest Thanksgiving opening weekend ever. That's great for movie theaters, and it's going to continue into December.
If it's a relationship, I'm just curious, Paul, that it can actually benefit both parties, theaters and streamers. How can that evolve from here? I mean, how do they keep that relationship evolving, getting stronger, and both benefiting from it?
Yeah, I think it's a combination deciding which films should go theatrical and which films should go straight to streaming. Once you establish that, you have to have a great marketing campaign to get these films ready to be put in theaters. And like we saw with Wicked and Gladiator 2, that combination became a marketer's dream. And then it's all about the windowing. It's about how long will that movie be in a theater before it lands on your small screen at home or on your device as you're traveling around. That's a key factor, because if people know a movie's going to be available, let's say in 2 weeks or 3 weeks, which would be an incredibly short window, then they may opt to wait until it hits the small screen. But the windows seem to be getting longer. We're seeing that recently with a lot of these big films doing so well in theaters that studios don't want to pull them out of there until they've really, until they're played out. So I think it's just going to be about more of that strategic windowing, figuring out when to go in theater. Once the film's in theaters, how long do you wait to then put it on streaming? And then it creates momentum going forward if there's sequels and other brands under that umbrella, like for instance with the Marvel movies, that people will ping pong back and forth between small screen and big screen offerings from that brand.
Some of the movies you were mentioning there, Paul, Wicked, Gladiator, Moana, maybe some skeptics would say, Paul, where are the new ideas? Where's the new material? You think that's a fair criticism?
Well, I think it is, but then when a lot of times moviegoers, what we saw over the summer in our Comscore data is that people were going to see Inside Out 2, Bad Boys Ride or Die, A Quiet Place Day One, Deadpool and Wolverine, Twisters. I mean, what's old is new again. It seems that the tried and true, especially when people are spending their hard-earned cash going out to the movie theater, they kind of want to know what they're going to get. But in the indie world, that's where you get those, films like Longlegs that did so well. And then, of course, we've got Anora out there, Conclave. On Christmas Day, you're going to have A Complete Unknown, the Timothée Chalamet, Bob Dylan biopic, Nicole Kidman and Baby Girl, and Robert Eggers' Nosferatu. So there's going to be original fare mixed in with Mufasa the Lion King, Sonic the Hedgehog 3, It's going to be quite a month for movies with the tried and true and Lord of the Rings. There's going to be a Lord of the Rings animated film on the 13th. So quite a combination of films out there for moviegoers. But also the big screen is there as well. People are getting off their couch, going to theaters. Then they come back home and they watch a lot of content. People who love content want all of this stuff.
Can't wait for that Robert Eggers one, Paul. Count me in on that. Thank you so much, as always, for joining us. And happy Thanksgiving, Paul.
Happy Thanksgiving.
Well, some breaking news this afternoon. The FTC has launched an antitrust investigation into Microsoft. The U.S. Federal Trade Commission is set to investigate everything from Microsoft's cloud computing and software licensing businesses to cybersecurity offerings and artificial intelligence products. This does come after the FTC had been conducting informal interviews for over a year with competitors and partners of the tech giant. According to people familiar with the plans, antitrust lawyers are set to meet with Microsoft competitors next week to gather more information. Microsoft shares are down slightly in after-hours trading following that news. We'll stick around. More Ask for a Trend right on the other side. Well, Thanksgiving is tomorrow, so why not do our chart of the day on the Macy's Thanksgiving Day Parade? Yahoo Finance's Julie Hyman joins me now.
Why not indeed? Do you put on the parade at home, Josh?
I sure don't, but I'm looking forward to this presentation, Julie. Maybe it'll spark my interest.
You're one of the few people who don't then, apparently, because this has been really one of the top rated, if not in some years, the top rated live events still on linear television in the entertainment category, and specifically, and in some cases, even surpassed some of the big sporting events. The Macy's Day Parade last year drew 28.5 million viewers. That was a record. It is one of the most remarkably consistent draws now for many decades for live TV viewership. And there's also a lot of money attached to the showing of the parade. Even if folks just have it on the background, they tend to have it on as they are preparing their Christmas meals or Thanksgiving meals or gathering with their families. NBC has had the rights to show the parade since 1953, but reportedly now Macy's is trying to renegotiate. NBC pays $20 million for those streaming rights, and the reported price that now Macy's is asking is closer to $60 million. But fear not, NBC brings in some cash for that too. According to reports that cite Guideline, which is an ad data firm, NBC last year charged sponsors an average of $865,000 for a 30-second spot during the parade. This year, it's closer to $900,000. And according to the New York Times, the company took in $52 million in advertising on the parade. So we'll see if they end up getting that renegotiated price for Macy's. And Josh, you gotta turn it on.
I think you sold me. It was interesting, though, in our morning meeting, Julie, question was raised about. I mean, it sounds like a lot of eyeballs, although, there's different kinds of watching. There's different kinds of viewing. I mean, I wonder how focused those eyeballs are.
It's a very good question. Again, whether it's in the background and you kind of like tune in and tune out, depending what's happening. You might have your favorite floats,
Which
for
float
example.
catches your eye? Sure, that
your
makes
favorite
sense.
balloons. There are always balloons that you wait to see. What are the new balloons each given year? Who are going to be the celebrities who come around the parade, and who's going to perform? These are the things that people watch for and maybe come back to the TV. I have to say, I was also telling the team that I used to go to a parade watching party where you would watch it in actual real life from someone's apartment. But guess what? They still had it on the TVs in the apartment, even so.
And then you got the National Dog Show, another staple.
Yeah,
right?
that's a good one too.
TV all
Love
day.
it.
Thank you, Julie. Appreciate it. Well, that is a wrap on today's Ask for a Trend. Be sure to come back Friday at 1 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night and have a happy Thanksgiving.